So Alex, as an analyst here at Linden Thomas and working with fixed income, explain the difference of what you guys do than a mutual fund or a bond fund.
I'd say the primary difference with Linden Thomas bonds is the control the individual investor has. The bond mutual fund, for example, their money is pooled alongside millions of other investors whose investment objectives and goals might not necessarily meet the same of the investor. With our bonds, we're selecting individual bonds of which the client has total control over. They're yield-focused bonds, and over time, the coupon payments will add up, which can be reinvested in additional bonds for the client leading up and point until retirement. And then at that point, when it does come time to retire, the client can use that yield to live off of, which in turn reduces the pressures on the equities and having to withdraw from your equity portfolio, which long term will provide the hedge against inflation, inflationary pressures that the client is looking for into their retirement years to hopefully create a sustainable lifestyle well into their golden years.
So Alex, talk to us about, as an analyst, the upside downside capture and risk that you deal with.
Upside downside capture is a pivotal part of portfolio construction. Long term, you're looking for your upside capture to outpace the downside capture portfolio. Reason being, that's how you grow your portfolio long term over the years. With a yield-focused bond portfolio, you're getting income above and beyond, let's say, traditional money market or lower yielding bonds, which in turn, that's money you have today that helps soften the downside capture. When applied appropriately, will help reduce the time to recovery and the time spent in the valley, which ultimately reduces long-term compounding for clients' portfolios.
Alex, let's go inside portfolio construction here at Linden Thomas. How do you guys manage risk differently?
Well, it starts with a blend of our earnings-focused separately account indexes, coupled with our quality-emphasized managers, coupled with our yield-focused fixed income. This blend put together hopes to reduce downside capture risk over time. And what we've shown and what we've seen is that if we can reduce downside capture risk and comparatively speaking have a larger upside capture ratio, that will lead towards long-term compounding and growth for the client's portfolio.
When we start out with a client, we want to set the goal, we want to understand the goal, but we also, on the flip side of that, we want to make sure that the portfolio construction is focused on trying to meet that goal.